Welcome to another unit in this course on economics. This time I want to talk about the money market. The money market is, well, not really a market as such, more like a construct, because there isn't really a market where you go and say, I want to buy money. So let's think about this more like an artificial construct to get some ideas of what is actually happening there. And well, before we get to the money market as such, we first need to talk about money demand, money supply. Well, because the money market is a market where supply and demand meet, so we need to talk about demand and supply. The supply part is relatively easy because there's only one institution who can offer money or supply money, and that's the central bank. So the central bank is the sole supplier of money and does it according to their own decisions. So it's more or less an exogenous variable not determined within the market. Well, this only leaves us with money demand, and this is closely related to the different functions of money. So here I make a short overview about the three functions that money has, or that any good which has to function as money needs to fulfill, and the demand motives for money, which, as I said, are closely related to this. So the first function of money is it needs to be able to act as a unit of calculation. Well, we don't need money to actually calculate something. So we don't actually need like physical or virtual euros to determine the price of a certain good. So it's not a demand motive, but it's still a very important function. However, the next function would be money needs to be a means of exchange. You need to be able to actually pay for things with whatever you use as money. This also gives us the first demand motive. We need money to transact, for transaction purposes, to consume, to buy goods. For exchanges, we need money. Be it physical, be it virtual, be it whatever type of money, we need money for transactions. Also, one other function of money, and that's critically related to a problem with all of this, with inflation, is money needs to act as a means to store wealth. If money loses its value too fast, it cannot fulfill this function and thereby isn't really money in the originally defined sense, because money needs to fulfill these three functions. Well, we have storage of wealth, and related to storage of wealth is the speculation motive. We actually need money to store wealth. To save money, we need money. So that's the speculation motive. Closely related to the speculation motive is the next point, which here is called the security motive. So we need money to pay for unforeseen future events. So that's like saving, but from a different perspective. This has more like an insurance character, whereas the speculation motive has more of like an investment character underlying it. And well, that's then it regarding the functions and the corresponding or additional demand motives for money. And usually, if we talk about the demand motives, we only focus on the first two because they are closely related to the functions money fulfills. The third one, the security motive, in many cases is just omitted. Okay, now we have the demand motives. We see that the demand is a bit more flexible than the supply. So let's still say a few words on money supply, on the central bank, or rather on how can the central bank impact the money supply. So which tools are available to the central bank to impact money supply? The first thing would be open market operations. So the central bank can buy or sell private or public obligations, stocks, or whatever. Not necessarily is this allowed in every country and for every central bank, but theoretically, it's a possibility that a central bank can act in such a way. Then we have Lombard credits. That's basically a credit given for a certain security. It's like if you need money, you go to a credit institute and you give them your watch or whatever, and you only get the watch back if you pay back the credit. Well, the central bank does not take watches, but it takes other kinds of securities from banks. So it gives a credit, which however needs to be backed up by some kind of securities. Then, from a different perspective, we have the so-called minimum reserve policy. And in the easiest version, this simply means depending on which type of savings the bank gets its money from, it always needs to keep a minimum of what they get as a reserve with the central bank and cannot give out this money which they got from savers in the form of credits. So they always, for the case that they might go bankrupt or that there is a relatively high demand for the money saved in a savings account, they need to be able to actually return the money to the savers, and to assure this working, to assure the ongoing liquidity of the banks, they have to hold the reserve, a certain amount of reserve with the central bank. Then the next one would be the idea of setting base interest rates or different types of interest rates, as with what is the interest rate that banks can borrow money from the central bank. This is closely related to standing facilities, with the idea that it's always possible for a bank to get money from the central bank, but usually only at a very high interest rate. So it's always available, especially if you have problems with your liquidity, to access money. However, that's not a tool to be taken lightly because it's relatively costly. However, if you just need short-term money, that's a good idea for the bank to get this. Then, finally, we have two different types of tender allocation procedures. That's if the central bank wants to bring money into the economy, but wants the money to go where it's mostly needed, to those banks which either mostly need this or can use this most efficiently. So how do they achieve this? Well, first off, we have the fixed rate tenders, and secondly, the so-called variable rate tenders. And the difference here is, in the first situation, the central bank only says, well, we are offering, for example, 2 million euros. And the 2 million euros you can get for an interest rate of, let's say, 2%. Who wants something? Then the banks give offers. I want 1 million, I want 500,000, and so forth. And after the bidding procedure, the 2 million are attributed to everyone who asked for it by the overall share in the total demand which exists. So meaning everyone who gave a bid gets something of the money, but not necessarily everything they wanted to have. So for example, you have 2 million, bank 1 wants 1 million, bank 2 wants the full 2 million, and another bank wants 1 million as well. So we have a total demand of 4 million, but only 2 million available. So each of the 3 banks will get something, but due to the fact that we only have 2 million available, and for example, the first bank wanted 1 million of the total demand of 4 million, so they wanted a quarter of the total, they will get a quarter of the 2 million. So they will get 500,000. The second bank wanted 2 million. 2 million out of the total of 4 makes 50%. So they will get 50% of the 2 million, so 1 million. That's the idea behind the fixed rate tender. In the variable rate tender, the central bank simply says, we are offering 2 million. How much do you want? And which interest rate are you willing to pay for this? This has one big advantage, because if you really need the money, you will be offering a higher interest rate. On the other hand, if you're just interested in this but do not really need the money, you will only offer a lower interest rate. So this can assure that the money either goes to those banks who really need this for liquidity purposes, or a money might offer a relatively high interest rate if they have a possibility to reinvest the money for an even higher interest rate. So if the bank really sees an opportunity here for a good investment, they will also offer more. So the central bank also tries to encourage this efficient use of the money. Of course, in this context, only those banks will get the money who offered the highest interest rates. So first, the bank with the highest bid is served, with the highest bid regarding the interest rate is served. Then whatever is left is given to the second highest bidder, then the third highest and the fourth highest, until everything the central bank is offered. So here there are some banks, or could be some banks, who do not get anything. And there's also 2 possibilities on how much they actually have to pay for this. There's a so-called Netherlands version or Dutch version. In the Dutch version, you only have to pay the lowest bid which is still served. So if 2 banks are served, one with 4% offer and one with a 3% offer or bid, both of them only have to pay 3%. In the US or American version, everyone has to pay what they actually bid. So the one with the 4% has to pay 4%, the one with the 3% has to pay 3%. That's the idea behind the variable rate tender. And this concludes then this part on money supply. So we had the demand side, we had the supply side. Now we can actually combine the 2 sides, giving us this illustration of the money market. Whereas here, that's the money supply via the central bank. That's the money demand via the different demand motives. The idea here is that on the one hand, we have the money amount available as compared to the worth or value of money. And well, that's then everything there is in regards to this session on the money market. So I say goodbye and see you next time.